Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Now, a put credit spread, let me kind of go with a precursory explanation of a put credit spread. That's what I would call a not bearish stance. We have the same sort of line in the sand with that as well, but here you need to make sure that between now and expiration the currency price stays above a certain price. And if it does, then what happens at expiration? The spread that you sold, got a credit for, expires and disappears, and you no longer have any risk associated with that spread because it's taken what we call in the professional option trading world off your sheets. It's gone. It expires. But the money you sold it for, well, that stays in your pocket. So typically, you would think of putting on a put credit spread if currency's trending higher, or maybe if it's oversold and you expect it to kind of, rebound just a little bit, move a teeny bit higher. Or if it's in a channel near the bottom of the channel, you expect a very slight rebound. If there's no news, or perhaps mildly bullish news on the currency itself. And also, for advanced people, you would trade a put credit spread if you're bearish on volatility. You think the option volatility is overpriced. Now, my same two rules of thumb exist for the put credit spread that did for the call credit spread. You want at least 3 weeks to 2 months until expiration. You find a spread that you think makes sense that has less than 3 weeks until expiration, knock your shorts off. Go for it. You're going to have a tough time. You're going to have a tough time finding one, but if you do, go for it. More than 2 months until expiration, hard to make a case for calling that a good credit spread. Too much time, too low of theta, or too low of a rate of time decay. To make the risk-reward reasonable, you need to have at least 10% of the spread width. So here we kind of have just the opposite. We need to stay above our line in the sand in order to enjoy a profit. We need to, when the spread expires, we need the currency to be above this break-even price. Okay, so there's your credit spread analysis. Let's kind of talk debit spreads. Just like there's 2 types of credit spreads, there's 2 types of debit spreads. A call debit spread and a put debit spread. A call debit spread is when I buy a call, usually at or out of the money, and I sell a higher strike call with the same month on the same underlying. A put debit spread is when I buy a put, usually at or out of the money, and I sell a lower strike put with the same month on the same underlying. So check this out here. You recall what a call credit spread was, right? Sell a call, buy a higher strike call. Well, this is, in some ways, just the opposite. In fact, in every way, it's just the opposite. And to be sure, when you make this trade, you are trading with someone somewhere else in the world. Now, you're sitting in front of your computer and, you hit send and all you know is you can buy it at, whatever, $2 and it gets sent to the ISE, routed through your broker to the ISE, and you don't really, all you know is you just get a report back that says, hey, I bought it. But there is a market maker who has trading privileges to trade with direct access on the ISE. He's called a market maker, and he's If you're buying a spread, he's selling you the spread. He's assuming a position that has just the opposite side. You know, it's kind of like when you buy an insurance policy, you're creating a contract with the insurance company, basically, right? You buy it from them, they sell it to you. You've got this asset, they've got this potential liability. That's exactly how it works with options. If you buy this spread, you're buying this asset. The market maker on the ice, he's incurring this potential liability. If at expiration, the spread is on one side of the line, the market maker wins. If it's on the other side of the line, you win. That's not exactly a 100% true statement. There's actually quite a bit more to it. But, you know, for now you can kind of think of it that way. So, you know, call debit spreads and put debit spreads are just the opposite side of the exact same coin as call credit spreads and put credit spreads. With call debit spreads, you know, people kind of look at it as a clever way of trading a directional position, notwithstanding the fact that it does have a time component. Basically, they do it, people traditionally and typically trade call debit spreads in place of just buying a call because it offsets the capital outlay on the call. You know, if I'm going to pay $5 for a call, I can buy that same call and sell a higher strike call for like $3, and next thing you know, oh look, I'm only paying $2 for this bullish position instead of $5. Now the risk reward's a little bit different. I have limited upside potential with a debit spread as opposed to unlimited upside potential with a call. So if you're screaming bullish, you would never trade a call debit spread. You would instead just buy a call. If you're moderately bullish, call debit spread is probably better. If you just buy a call, the reason a lot of people don't like buying outright options is because of this time decay we were talking about. Here, you know, a credit spread is called a credit spread because you take in a credit when you make the trade. A debit spread is called a debit spread because when you make the trade, you buy it. You actually pay money. That means this idea of time decay risk works against you. The spread that you paid money for gets worth a little less. You don't want things that you buy to get worth less, whether that's options or, you know, houses or whatever. When you own something, you want it to get worth more, not less. Time decay makes things worth less. So here, this is why these spreads can be clever in terms of time decay, is that instead of just going out and buying a call, here we're buying one call and selling another call. So one call has the detriment of time decay affecting it, but one call has the benefit of time decay affecting it. So we hedge off some time decay risk. And we hedge off volatility risk too. Now, that's kind of for more advanced people, but you know, I'll just kind of make the statement here, and perhaps we can address this at the end in the Q&A section. You know, when there's takeover rumors or earnings, you know, a fair number of different scenarios, the expensive options can become more. Implied volatility rises. People trade debit spreads to hedge off implied volatility because you're buying one option, getting long implied volatility, but selling another option, getting short implied volatility. So here for smaller moves, like moves just up to a certain point, you can have a way higher percentage gain with less nominal capital at risk with the debit spread than you can with just going out and buying a call. You use this when you're bullish to a point. The stock's in an uptrend. It's not going to the moon, you don't think. Maybe there's some resistance above. You think it's just going to go up to that resistance level. You know, it's a tepidly bullish stance. Maybe you're bullish on volatility. Maybe you're hedging volatility. But the 3 weeks to 2 months time horizon, that stays pat. That rule of thumb still exists. Now, shorter than 3 weeks, fine. You have a tough time finding a good debit spread with less than 3 weeks, but you can find it fine. More than 2 months, not good. Because you don't make your maximum profit potential until you're pretty close to expiration. There's an inherent time factor to these spreads as well. So here, look. You need the underlying currency to be above a certain price. Ideally, you want it to be at or even somewhere above both call strike prices. You want them both to be in the money at expiration. That's where you reach your maximum value. If both are out of the money at expiration, you know what happens? Well, what you paid for becomes worthless. It expires and it's gone. So therefore, the money you spent cannot be recovered, and it represents 100% loss of the spread. Now, again, what you pay for the spread is much less than what you would pay for an outright long call, which is much less than what you would pay if you were actually buying the spot, or at least better risk reward. So, you know, you need it to be above the specific price at expiration. Now, put debit spread, same idea, and I don't think I need to spend too much time on this. We use that when we're bearish to a point. Stocks, or the currency rather, is in a downtrend, but maybe there's some support. You think it might drop down to support. Some mildly bearish news. So why don't you just buy a put? Because here you buy one put, but you sell another one to offset the capital outlay, to hedge the time decay risk, maybe to hedge the implied volatility risk. And if you just get a small move, because you're shelling out less money, you can have a bigger, higher percentage gain. Now, a real big move, no, you're going to leave money on the table. So you only do this if you're looking for a limited move. 3 weeks to 2 months time horizon, that goes without saying. Put debit spread, you know, it's the same idea. There is a line in the sand. The line is right here at this point. It's called your break-even point. As long as we're below that point, as far as the price of the currency goes, we have a profit. If we're above that point, we have a loss. Now, best case scenario, we get a little bit of a downtrend. The price of the currency, you know, declines and is below both put strikes, making them both in the money at expiration. If that's the case, this put that you bought, here's your long strike, this put that you bought, you can exercise, therefore getting short the currency. And this put that you sold, you would get assigned, therefore buying back the currency that you shorted at this price. So basically, if we're down here, you're allowed to positive scalp. You lock in money. Now, you know, that's kind of a precursory look. There's a little something for everybody. It's a crash course for beginners. Probably mentioned some important things to intermediate people that they may not have known. And we kind of superficially discussed the volatility impacts for the advanced people. Now we're going to go into the appropriate way to analyze risk. And this is for everybody. Whether you're brand new to options or you've been trading for 20 years, everybody needs to look at options risk the same way. Now, I know there's a lot of people out there who, you know, teach you the beginner way and teach you the intermediate way and teach you the advanced way. Look, man, that doesn't really exist. There's the right way and there's the wrong way. Here's how you must analyze risk. really, this is kind of a universal slide with all option trades. Either look at it in terms of absolute risk or incremental risk. Absolute risk is just simply your risk that's illustrated on a P&L diagram. It gives your maximum gain, your maximum loss, and your break even at expiration, or when all the time value is left the option. Incremental risk, well, that measures your changes in the price of the underlying, like today, not at expiration. What happens if the underlying moves, 5% in the next 24 hours? What happens? What happens as each day passes? I spent a lot of time here talking about the fact that options lose value and that, you can profit or lose from losing, those options losing value in terms of time decay. Well, how much? A lot or a little? Do I give up 1/100th of a percent of my spread value? Or do I give up 50% of my spread value? You got to know. You need to measure the effect of time decay. And you need to measure the effects of volatility. Now, fortunately, option traders have a system of monitoring that risk. It's called the Greeks. Here's a little crash course on the Greeks. Now, by the way, my coaching students, I take students for coaching. And I teach them, one-on-one education. It's just me and you online for 9 hours throughout your time with me, as well as, homework. And I give you my book, Trading Option Greeks, and, have you attend my online education and watch online videos. I mean, there's a ton more. But the one-on-one aspect, I spend a lot of time with my coaching students going over the Greeks. Students who are brand new to options, just learning what a call and a put, what calls and puts are, great. Let me talk about the Greeks so that you understand how these things actually work in the real world. People who have been trading for 20 years come to me to be coaching students. I talk about the Greeks with them too because they never really learned the right way to trade. This is something every single one of you must have mastered, or else, honestly, you shouldn't be trading options because you're going to run into trouble because you're just kind of winging it. Let's talk about delta first. Option prices change in value, not as much as the underlying currency, but if the underlying currency goes up by X amount, then the option spread goes up by X amount too, or down by X amount if it's put. Delta measures that. Delta is the rate of change of an option price relative to a change in the underlying currency. Now, I've talked about time decay. Option prices decrease as time passes. This is known as time decay or erosion. If I own an option or an option spread, like a debit spread, time decay hurts. If I'm short an option or an option spread, like a credit spread, time decay helps. When options are in the money, only the extrinsic value or the non-in-the-money part of the option decays in value. That decrease in value is measured by theta. Theta is the Greek that measures the rate of change of an option's value given a change in the time to expiration. Vega is the rate of change of an option value relative to a change in implied volatility. Vega and theta are both measured in dollars and cents. When you look at an option chain, you will see a number like 0.04. It's 4 cents. That's like the typical theta or vega, illustration. Now let's go through a real example here. Now that you know what it is and you have all the tools, let's talk about a credit spread here in YUK. We're looking at this currency here. We're in a little bit of a downtrend. We think that it might continue or it might taper off. We don't think it's going back up. Call credit spread might be perfect. Maybe we can look at this call credit spread. Sell the 83 and a half spread. It's 8 bid at 20 cents. Now, 8 bid at 20 cents, that's a pretty wide market. I'm going to let you guys in on a little secret here. You ever try to cut the markets, middle of the markets? Market makers hate when you do that. It's taking money out of their pockets, but it's keeping money in your pocket. The bid-ask spread is a transaction cost. You might not realize it, but it is. If you're out there just buying a call or buying a put, it's going to be pretty tough to middle the markets. Those big delta options and big vega and big theta options, market makers don't want to give you a break and let you have some of their money. They have risk if they're trading outright options. But if you trade a spread, they have way less risk. Their delta smaller, so that means they need to do less of the underlying to hedge. Their theta and vega are smaller, so they have less option-centric risk. And the markets, because there's two options in the spread, the markets are twice as wide on a spread. So market makers often, not always, but often concede and let you middle their markets. And so we're assuming that we were able to do that. Instead of hitting the bid at 8 cents, we're selling it at 10 cents. So credit spreads. What's the rules now again? Oh, yeah. Your maximum gain on a credit spread is the premium you received. If these calls are both out of the money at expiration, you get to keep that 10 cents forever and ever and ever. Now, the max loss is the distance between the two strikes. So 83 and a half minus 83, that's 50 cents. Minus the credit you received. So 50 cents minus 10 cents is 40 cents. So now you look at this and you say, wait a minute. I can only make 10 cents, but I can lose 40 cents? That's ridiculous. Why would I ever want to do that? Well, here's why. The reason is because this is a high probability trade. YUK was at like 81 and change when I did the screenshot. You would have to rise up a whole, $2 or something in order to have a loser. If it falls, winner. If it stays the same, winner. If it rises a little, winner. If it rises a lot, loser. Your chances of making money are way better than your chances of losing money. This is why these spreads are attractive. Incremental risk your P&L diagram, so what? You need to, ideally you want this currency to be below 83 at expiration. If it's above 83, well, as long as it's, not more than 10 cents higher than 83, you have a profit. If it's higher than that, you have a loser, and if it's up above 83 and a half, well, then you lose your maximum value.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.